In 2009, a city's real estate was priced for extinction. Detroit's median home cost just $58,900, while $20 billion in municipal debt loomed overhead. 3 years later, Chapter 9 bankruptcy shattered the final illusion of stability. Yet by 2024, an investor's $11,780 down payment here could have multiplied more than 20 times. What triggered such a violent reversal in a place so widely written off? This is the forensic story of how catastrophic collapse became institutional gold, if you saw the signal before anyone else. Detroit's fiscal unraveling reached its peak between 2009 and 2013, when the city became a national symbol of urban distress. On July 18, 2013, Detroit filed for Chapter 9 bankruptcy, burdened by $20 billion in debt, the largest municipal insolvency in American history. The city's balance sheet was overwhelmed by unfunded pension liabilities, declining tax revenues, and the collapse of core industries. In neighborhoods across Detroit, boarded-up homes outnumbered occupied ones. Entire blocks sat vacant, punctuated by the occasional cash-only sale, as traditional mortgage financing all but disappeared. Less than 1 in 5 home purchases involved a lender, the rest closed in cash, often at prices that reflected little more than land value. The median sale price for a house in 2009 was just $58,900, a figure that signaled both the market's bottom and the depth of investor pessimism. Public services withered under the strain. Streetlights went dark. Police response times stretched past an hour, and city payrolls shrank. The housing ecosystem itself fractured, with title issues and missing warranty deeds introducing new risks for buyers and sellers alike. Detroit's municipal government, once the steward of the nation's 4th largest city, now struggled to provide even basic services. The city's fiscal crisis became structural, not cyclical, and the real estate market priced in the possibility of permanent decline. This was a market where assets traded at a discount so extreme that the very definition of value was in question. The conditions for a future reversal were set not by hope, but by the sheer exhaustion of downside. August 2010, Quicken Loans completed its headquarters relocation, planting nearly 1,700 employees in downtown Detroit at the height of the city's distress. This was not a symbolic gesture. The move initiated a sustained wave of private capital, with Dan Gilbert's Rock Ventures and Bedrock deploying approximately $5 billion over the next decade, half of it directed specifically to real estate acquisition and development in the city's core. By 2018, Bedrock's portfolio spanned more than 100 properties and 18 million square feet, reshaping the downtown landscape. These investments were not isolated bets. They established a new baseline for institutional confidence in Detroit's commercial and residential assets. Over 100 companies followed Quicken into the city, drawn by the visible commitment of permanent capital and the infrastructure that followed. The private surge was reinforced by public initiatives. The Strategic Neighborhood Fund, launched in 2017, ultimately pooled around $172 million from city, philanthropic, and corporate partners to stabilize and upgrade targeted neighborhoods with new housing, parks, and commercial corridors. According to a third-party economic impact study commissioned by Rock Ventures, this combined wave of investment generated an estimated $13 billion in statewide economic output and $1.2 billion in state and local tax revenues. These are modeled impacts, not audited fiscal receipts, but the directional effect is clear. The risk profile of Detroit real estate was re-rated. For the first time in a generation, the city's fiscal future was anchored by a partnership between large-scale private capital and coordinated public policy. Detroit's price trajectory over the past decade can be mapped in stark numbers. In 2014, the median home sale in the city stood at $36,680, according to transaction-level analysis by the University of Michigan. By 2022, that figure had climbed to $68,640, representing a 124% increase over 8 years. Investor-facing MLS data places the citywide median between $90,800 and $95,000 by late 2024, more than doubling the 2014 baseline. For a buyer who entered at the 2014 median with a standard 20% down payment, about $7,336, the appreciation alone would have produced a gain of roughly $56,000 in property value. That translates to a 768% return on the original equity before accounting for any rental income or principal paydown. The leverage effect magnified each dollar of invested capital, turning modest down payments into substantial household wealth. In select neighborhoods where values rose by 300 to 1,000%, early buyers saw even more dramatic multipliers, but the citywide math itself demonstrates the scale of repricing. The mechanics of this price appreciation set the stage for understanding how aggregate residential wealth was rebuilt across Detroit's owner-occupied housing stock. Detroit's housing market, once written off by national analysts, began to amass residential wealth at a scale rarely seen in modern American cities. According to University of Michigan analysis, the net value of owner-occupied homes doubled from $4.2 billion in 2014 to $8.1 billion by 2022. That's a $3.9 billion increase in aggregate homeowner equity over just 8 years, driven by both rising median sale prices and a growing share of homes transitioning from distress to stable ownership. This wealth surge was not confined to a handful of high-profile developments. It played out across hundreds of neighborhoods, each contributing to the city's expanding residential ledger. Annual gains reached record territory in the early 2020s, with some years adding more than $1 billion in housing value citywide. The city's residential wealth engine, once idling at historic lows, was now running at full throttle. These numbers capture a collective transformation, thousands of households, each with a balance sheet that looked markedly different by 2022 than it had a decade before. Aggregate value growth became the city's silent recovery, measured not in headlines, but in assessor rolls and closing statements. Rental income provided a second engine for Detroit's real estate recovery. Since 2019, annual rent growth in the city reached 4.5%, outpacing many legacy markets and adding a steady layer of cash flow to the appreciation-driven gains. In 2023, the median gross rent in Detroit stood at $1,043 per month, compared to $1,183 in the broader metro area and a national average of $1,406. This gap signaled both affordability and room for further growth, especially as new residents arrived in revitalized districts. Over the same period, 7,853 new housing units were added. That was a physical measure of the city's renewal, but also a test of whether supply could keep up with rising demand. For investors willing to navigate operational risk, the Detroit Land Bank Authority offered a radically different entry point. Properties could be acquired for as little as $1,000, but these purchases came with significant renovation requirements and the realities of code enforcement, tax compliance, and neighborhood volatility. The Land Bank's model created an asymmetric opportunity, a low-cost ticket to potential upside balanced against the high probability of carry costs and capital calls. In this environment, yield depended as much on operational discipline as on market timing. The income side of Detroit's recovery was never passive. It required active management and a tolerance for uncertainty. But for those who succeeded, rental yield and price appreciation worked in tandem to rebuild household and institutional wealth. By October 2025, Midtown Detroit's median sale price landed at $295,000, but this figure concealed a sharp reversal, an 11.9% year-over-year decline. The correction was not confined to a single block or building type. Instead, it reflected a broader recalibration as the city's most sought-after districts faced a new kind of risk: oversupply at the high end and a mismatch between asking prices and local incomes. At the metro level, fundamental value models flagged a 40.8% overvaluation rate for 2024, raising red flags for risk committees and institutional allocators. The same leverage that amplified gains in the early recovery now threatened to invert, especially for late-cycle buyers who entered on the back of momentum rather than deep value. Interest rates, which had remained low for much of the boom, began to exert downward pressure on both affordability and asset prices, eroding the cushion that once protected leveraged positions. For investors, the late-cycle signals were clear. The era of indiscriminate appreciation had ended. Asset selection, underwriting discipline, and a granular understanding of neighborhood-level demand would define the next phase, as Detroit's real estate market transitioned from recovery to a more mature, risk-sensitive environment. Detroit's market is now priced above fundamentals, with Metro Detroit overvalued by more than 40%. What once rewarded risk now demands scrutiny. For investors, the lesson endures. Capital floods in during distress, but true returns depend on timing the next inflection point. Where will the next signal hide?